And now with QE2 coming to an end, I need to know what happened after QE1, was done.
Right, you bet, Scott. So I wanted to take a look at what happens next week. So we're headed into June, right, which is summer, yay, but also we're going to wind out the end of QE2, the Fed's $600 billion bond buying program. So what can you expect? Now, according to S&P Equity research between QE1 and QE2, so basically March 2010 to November 2010, telecoms were the biggest winners, rising 21.3%. We also saw consumer discretionary followed at 19.7%, and materials were up 18.2%. So logically, this means that the sectors could see more money inflows, right? Sort of a safe haven, a good place to stash your cash as the Fed caps the amount of free money in the system, right? Okay, maybe not, and here's why. In mid-August 2010, that's when we started to hear rumblings of a possible QE2. So if we think that QE2 actually started in mid-August, the winners weren't so hot, and we had some big-time losers. We saw healthcare tanking 7.5%, energy losing 4.5%, financials were down 4.2%, and tech shedding 4%. Now, in total, the S&P dropped 16% from April through July, which would take us to 1,100 if we were to see that kind of correction right now. So if we do see that kind of pain and winners like healthcare give up gains like we've seen recently, what does that actually mean? And I was talking to Sam Stovall, Chief Investment Strategist at S&P, who told me that the economy and markets could see more of a soft patch in the second quarter, basically a dip before the recovery sort of kicks back in. He also told me there would be a readjustment of long-term earnings expectations and growth expectations, but that the bias would still be to the upside. I'm going to bring Scott into the conversation as to what this actually means for traders and for your portfolio right after this.